What if everything we thought we knew about Japan's recovery is completely backwards? A country once known for its economic miracle now, appearing to bounce back might be masking a crisis that's far from over. Japan's stock market just hit an all-time high. Inflation is, for the first time in decades, back in positive territory with a 3.5% jump in prices in the last year, and unemployment basically non-existent. The jobless rate is hovering just slightly above 2%. On the surface, it looks perfect, prosperity restored, lost decades overcome. But here's the twist. What if this entire comeback story is artificially propped up by the Bank of Japan? What if the growth, the soaring markets, and the return of inflation are all symptoms of a deeper monetary illusion? In today's Enoch Report, we'll dissect why Japan's apparent economic revival may be more fiction than fact, the root causes behind this so-called deadlock that began 3 decades ago, how recent shifts in policy by the Bank of Japan could trigger consequences far worse than anyone expects. So here's the question for you. Do you think Japan has truly walked out of its lost decades? Or is this the calm before another economic storm? Yes or no? Drop your thoughts in the comments. Because what's buried at the heart of this story could reshape how the world views. It's one of its most respected economies, and what that means for financial markets around the globe. Let's get into the truth behind the headline numbers. If you asked most economists to evaluate a country where the stock market is hitting record highs, unemployment is under 2.5%, and inflation hovers at a healthy 3%, they'd probably say that economy is performing beautifully. And yet that very description fits present-day Japan. Many around the world, especially in places like Hong Kong, look to Japan as a second home, a stable, orderly powerhouse, grounded in culture and economic steadiness. But we need to ask, do these high-level figures truly reflect reality on the ground? Let's start with the most obvious headline. The Nikkei index is up 5-fold since its bottom in 2009. And in 2024, it finally broke through a historic ceiling. The same peak reached during the height of Japan's 1990s asset bubble. To the casual observer, that seems like a triumphant exit from the infamous lost decades. But here's the problem. A huge portion of that market growth was directly engineered. Starting in 2012, Bank of Japan began injecting 6 trillion yen annually into domestic ETFs, stock funds tracking Japan's own market. They did this consistently until 2021. Yes, Japan was using national funds to purchase their own stock market, artificially inflating asset prices. That's not a free market rally. That's public sector intervention on steroids. And while they've dialed back the purchases recently, we have to ask, would the Nikkei have risen anywhere near as high without this massive stimulus? Are these record highs truly the result of strong corporate performance? Because even if big firms are raking in profit, that doesn't mean life has improved for medium-sized companies or working-class citizens. Numbers on a stock chart don't always translate to prosperity on the street. Next up, inflation. For decades, deflation plagued Japan. Now, after years of zero or negative inflation, prices have finally started rising. In 2024, Japanese companies posted their largest average wage hikes in recent memory, 5.3%. That sounds promising until you realize wages still aren't keeping up with inflation. Since inflation returned in 2022, real wages, what people can actually buy with their paychecks, have been shrinking, and recently it's gotten even worse. The more companies raise pay, the less it seems to matter in actual purchasing power. So what's fueling this strange paradox? The answer lies in Japan's deep dependence on imports. Japan, an island nation with limited natural resources, relies heavily on importing essentials: energy, food, raw materials. And with the yen having fallen more than 23% since 2022 based on real effective exchange rate measures, all those imports have suddenly become more expensive, without anyone in Japan actually doing anything differently. It's not that Japan's people are spending wildly, it's that their currency is buying them less. Companies, in turn, raise prices to preserve margins. This chain reaction creates what economists call imported inflation, price increases driven not by domestic demand, but by a weak currency and rising import costs. So when we see inflation returning in Japan, it's not because of a roaring economy. It's because the global price tag on Japan's necessities just went up, and the yen couldn't keep up. So we've got a pumped-up stock market and inflation that's more symptom than signal of real growth. What about GDP? Japan's real GDP growth has hovered near zero for years. There's no strong domestic engine driving a true revival. Against this backdrop, Japan's economy seems less like a phoenix, rising, and more like a patient on life support, and the monetary morphine keeping it stable may not be working much longer. Let's revisit what got us here. The Bank of Japan's three policy arrows that defined its crisis response over the last 2 decades. First, aggressive quantitative easing, essentially printing money to uplift the economy after the 90s asset bubble burst. Second, yield curve control, to keep long-term interest rates low even. When inflation rose, the BOJ kept buying government bonds, distorting the risk-free benchmark rate that underpins the entire economy. Third, a negative interest rate policy. This move penalized those who left their money in savings, nudging them into consumption and riskier investment options. In theory, this triple play should have rebuilt demand and given companies confidence to invest. But after all that, what did Japan get? Not growth driven by households or strong consumption, not productivity-driven expansion. No, it got weakening currency-induced inflation and that only made imported goods more expensive. Things like a $10 bowl of ramen in Tokyo still feel like a steal if you're a tourist. But for residents earning in yen, it's increasingly unaffordable. So the Bank of Japan has decided, time to start reversing course. Here's where things turn fast. Recently, the BOJ announced a major strategy shift. It's reducing government bond issuance, starting a quantitative tightening QT phase. It halted yield curve control, allowing long-term rates to rise freely, scrapped negative interest rates, lifting short-term rates to 0.5%. The markets didn't take this move lightly. 10-year bond yields broke above 1% for the first time in years, nearing crisis-era highs. 30- and 40-year bonds spiked even more. This means borrowing costs for the government and companies, and households have surged precisely when debt levels are astronomically high. Japan's debt-to-GDP ratio is among the worst in the developed world. Suddenly, debt service costs are swelling. Investment by businesses slows. Mortgages become more expensive. The average person, they feel the squeeze the hardest. The BOJ now hints they may scale back. QT, there's talk of re-entering the bond market to stabilize yields, effectively stepping back into the easing cycle again. Why? Because the broader economy may not be equipped to handle normal financial conditions. The slightest tightening has already pushed GDP growth back into negative territory. If you're still watching, you're clearly here for more than surface-level takes. At Enoch Report, we unravel the deeper currents behind economic headlines, the stuff the mainstream often misses. Be sure to hit that subscribe button and turn on the bell, so you never miss a report that can truly impact your financial outlook. The real trap is this: Japan can't raise rates too high. The economy stalls. But it also can't cut rates. The yen collapses again. Meanwhile, Japan is no longer the export powerhouse it once was. Instead, it's running persistent trade deficits. It relies on buying from the world more than selling to it. So where does the money come from? When your currency is weak and you need expensive imports, do you borrow more, print again, tighten and risk a crash? This is the perfect deadlock Japan now faces. And don't forget, much of the global financial system has leaned on Japan's low interest rates for years. Investors borrowed yen at near zero cost and invested elsewhere for higher returns. If that carry trade unwinds, the ripple effect could rock global markets. So has Japan really risen from its economic slumber? Not quite. Revival built on imported inflation, artificial stock supports, and shallow GDP growth is not a true resurgence. Until Japan can consistently grow domestic demand, rein in trade deficits, and foster organic inflation through productivity, not currency gimmicks, it remains on borrowed time. And here's our question to you. Is Japan caught in an inescapable economic loop? Or are we underestimating its path to renewal? Leave your take in the comments below, yes or no. Can Japan truly recover? If this breakdown gave you insights you didn't hear on the evening news, don't just like it. Follow Enoch Report and hit that bell icon. Because in moments like this, Timing and information can mean the difference between riding the wave or getting dragged under it. See you next week with more unfiltered economic intelligence. Till then, stay informed.